You're listening to Earnings Unscripted, where we unpack what really happened in today's earnings without the corporate PR filter. It is Thursday, January 22nd, 2026.
The future is now.
It certainly feels like it. Today, we are digging into GE Aerospace. This was their Q4 report, and honestly, it's a bit of a Rorschach test. Depending on where you look, it's either the greatest quarter in history or a margin squeeze nightmare. Oh, and before we dive in, quick reminder that this is just two friends chatting. None of this is financial advice, so please do your own due diligence. Okay, Miro, set the scene. How did it feel?
Heavy. Look, the headline number is absurd. Total orders hit $27 billion just for the quarter. To put that in perspective, the run rate for the rest of the year was barely half that. So demand, off the charts.
Right. 27 billion is massive. That's like the GDP of Iceland. But the market didn't exactly throw a parade, did it?
No. It was a classic fade. In the pre-market, the algos saw that order book and ripped the stock up to 338. But the second the call started, the selling hit. It slid all morning and closed near the lows around 301, down about 5% from the highs.
Ouch. So the traders woke up, read the fine print, and bailed. Why? What spooked them?
Profitability, or lack of momentum there. Adjusted revenue was up 5% to $11.9 billion, which is fine. But operating profit was basically flat at $2.27 billion. And here's the kicker. Margins actually compressed. They dropped from 20.3% last quarter down to 19.2%. EPS came in at $1.57, which is down from $1.66 in Q3.
Wait, hold on. So they booked $27 billion in orders, revenue is up, but they made less money per share than 3 months ago? How does that math work?
It's the mix trap. We talk about this a lot. Basically, GE is selling a ton of new engines right now, the LEAP and the new GE9X. Selling a new engine is a low-margin game, sometimes even negative margin early on. Where they make the real money is on services and spare parts later. But right now, they are shipping hardware, and hardware is expensive.
So it's the classic razor and blades model, but right now they're shipping a mountain of razors at a discount.
Exactly. And the blades, the spare parts, saw a lower ratio this quarter. Plus, they are pouring money into R&D for defense and next-gen tech. So you have high spend, lower margin mix, and, well, you get a margin of 19% instead of 20%.
Which, to be fair, is still decent for heavy industry. But I guess when you're priced for perfection, decent gets you sold off.
Precisely. The backlog is now $190 billion. That is an insane safety net. But the market is asking, great, you have the orders, but can you actually build them profitably?
Yeah. And speaking of building them, there was that weird note about inventory climbing by $2 billion last year. That feels like a lot of cash sitting on the shelf.
It is. And that's the friction point. They're calling it buffer stock to handle supply chain chaos. But when inventory goes up and free cash flow drops, it was $1.76 billion this quarter, down significantly from Q3. It tells you the factory floor isn't flowing as smooth as they say.
Right. It's like buying a year's worth of flour because you're scared the grocery store might close, but now your kitchen is full of sacks and you can't move.
That is surprisingly accurate.
All right, so we have a massive backlog, a margin squeeze, and a nervous stock market. But there is one detail in the guidance that I think everyone glossed over, and it's kind of a game changer for how the company looks next year.
Oh, you mean the shell game with the segments?
You are so cynical. Shell game. Let's call it a strategic realignment. Let's get into the details.
Strategic realignment. Right. So here's the machinery under the hood. Effective Q1 2026, GE is taking their Aeroderivatives business, these are basically jet engines modified for power plants on the ground, and moving them from the commercial segment to the defense segment.
Okay, sounds boring. Why should I care which bucket the revenue sits in?
Because buckets determine the narrative. Look, at the defense numbers this quarter, margins collapsed. They fell to 8.9%. That is ugly.
Meanwhile, commercial is the golden child. By moving Aeroderivatives, which is a roughly $1.4 billion business with decent margins, over to defense, you instantly inflate the profitability of the defense segment next year.
Oh, I see. It's like moving the honor roll student into the struggling class to bring up the grade average.
That is exactly what it is. It's optical. It doesn't change the cash flow of the company, but it stops investors from asking why defense margins look so weak in 2026. It solves a perception problem, not an operational one.
Cheeky. I kind of respect the hustle, but surely they're doing something real to fix the problems, right? They can't just shuffle spreadsheets to deliver a $190 billion backlog.
No, and to give them credit, that is where the real story is. Forget the accounting shuffle. The actual engineering win this quarter was something the CEO called batch to flow.
Batch to flow sounds like a yoga position.
I wish. It's gritty factory floor stuff. For decades, aviation manufacturing was done in batches. You build 50 turbine blades, put them in a bin, wait 2 weeks, then move the bin to the next station. It's efficient for the machine, but terrible for speed. They are finally implementing this flight deck lean model where they move to single-piece flow. Just keep the part moving.
And did it work, or is this just corporate speak for we tried harder?
No, the data is actually there. They claimed it reduced turnaround times, the time it takes to overhaul an engine, by more than 10% for the LEAP and CFM 56 lines. Now, Susie, in this industry, a 10% speed gain is massive. That is the difference between an airline yelling at you or thanking you.
So that explains the inventory build we talked about earlier.
Precisely. To run a flow line, you need parts ready instantly. You cannot wait for a supplier. So they soaked up $2 billion of inventory to make sure the line never stops. It looks bad on the cash flow statement today, but it's the only way they clear that backlog tomorrow.
So they are sacrificing cash now to buy velocity later. That actually makes sense. It's risky, but logical.
It is, but there is a catch. There is always a catch. While they're fixing the old engines faster, the new engine, the GE 9X for the big Boeing 777X, is about to become a massive money pit. The CFO quietly admitted that losses on the GE 9X program are going to double in 2026.
Double? Ouch. Why?
Because they're ramping up production. When you build the first few hundred engines of a new type, you have zero learning curve leverage. Every unit costs a fortune. So you have this weird dynamic. The old business, services, is getting faster and leaner, but the new business, GE 9X, is going to eat up all that profit growth for the next 12 months.
So it's a tug of war. Efficiency pulling one way, new product ramp pulling the other.
Exactly. And that flat margin guidance for 2026, that is the sound of those two forces canceling each other out.
All right. That completely changes how I read the report. It's not stagnation, it's a transition period. They're basically retooling the entire machine while it's flying.
Yeah, that's the part that really changes how I see their whole strategy. It's aggressive.
So let's step back for a second and think about what all this means going forward. Does the market have the patience for a transition?
Short answer, no. The market hates transition years. To a trader, a transition year is just code for dead money.
Right, because even with a $190 billion backlog, investors see that flat margin guidance for 2026 and they get twitchy. It's like having a winning lottery ticket, but being told you can't cash it until you fix the plumbing in your house.
That is actually a pretty good analogy. Look, the guidance is for roughly 8 to 8.4 billion in free cash flow next year. That is an objectively massive amount of cash. But the growth rate of that cash is slowing down because of the GE 9X losses we talked about.
So the narrative shifts. It's no longer a recovery story where everything bounces back from the bottom. Now it's an execution story.
Exactly. The easy money has been made. Now they have to actually grind it out. If that flight deck model works and they keep cutting turnaround times, the stock works. If they stumble and that inventory pile keeps growing without shipping, that backlog turns from an asset into a liability. Penalties, angry airlines. It gets messy fast.
It's funny, isn't it? We spend so much time talking about AI and hyperscalers and magic software margins, but GE's reality is just physical. It's, can we move this turbine blade 3 feet to the left faster than we did yesterday?
It is unglamorous, but that is the industrial reality. It is entropy management, and frankly, generating $8 billion in cash for moving metal is harder than writing code.
Fair point. So the verdict?
Cautiously boring. I think the stock goes sideways until they prove the margin squeeze is temporary. But the machine itself, it's healthy. They are just changing the gears.
Cautiously boring. I think I'll put that on a t-shirt. All right, that feels like a good place to land the plane.
Pun intended?
Obviously. Thanks for hanging out with us for this one. It's a dense report, but the boring ones are usually where the real money is hiding.
Usually. Until next time.
And just before we fully close out the feed, I want to take a quick moment to pull back the curtain on what you're actually listening to. Earnings Unscripted is an experiment. It's a project by a small team of enthusiasts who are exploring the absolute frontier of generative AI, and specifically, how it can be used to enrich our understanding of the world, rather than just generating more noise. What you heard today was created by a coordinated team of AI agents.
It starts with a research analyst agent digging through the raw 8Ks and transcripts, passing that data to a scriptwriter, then to a fact-checking QA specialist, and finally, to the voices of Miro and myself. We are all working together in a digital newsroom to deliver high-quality, up-to-the-minute information in a way that would hardly be possible otherwise. It is about combining the speed of machines with the curiosity of, well, people like you.
We are still learning, and we would love to know what you think. If you have questions, comments, or just want to see how the sausage is made, please reach out at earningsunscripted@datamadness.ca or follow the project on X. Thanks for being part of the experiment.
See you after the next call.